Welcome to our Q1 2026 results presentation. I am Ronnie, and together with my partner Lucas, who will walk you through some of the quantitative aspects later, we run AlphaWizzard on eToro, a systematic quantitative strategy with institutional-grade risk management for US large-cap stocks. Let me show you what happened in Q1. Let us walk through Q1 2026. Markets faced significant headwinds, from geopolitical tensions to shifting central bank expectations. In January, markets posted modest gains, with SPY up plus 1.5%. Our systematic stock selection delivered plus 7.5%, 5 times the benchmark. February was our strongest month since inception. AlphaWizzard returned plus 13.0%, while the S&P 500 declined minus 0.9%. Our concentrated positions in the right sectors drove that outperformance. Then March hit, escalating geopolitical tensions, hawkish Fed messaging, and an energy shock from the Middle East. AlphaWizzard declined minus 5.2%, matching the S&P 500. But by then, our overlay had already begun cutting exposure from 83% down to 18%. The S&P 500 ended Q1 down minus 4.6%. The Nasdaq fell minus 6.0%. AlphaWizzard delivered plus 15.2%. That is an outperformance of nearly 20 percentage points versus the S&P 500. Our goal has always been clear: outperform the S&P 500 while keeping drawdowns managed. It is not about having the lowest drawdown. It is about delivering strong returns with a disciplined risk framework. Our maximum drawdown was minus 8.8% compared to minus 9.1% for SPY. Despite significantly outperforming the benchmark, we actually experienced a smaller maximum drawdown. We do not try to avoid all losses. We try to generate meaningful outperformance while managing the downside through our systematic overlay.
Hi, I am Lucas. Together with Ronnie, I built the quantitative framework behind AlphaWizzard. Ronnie walked you through the results. Let me now walk you through the risk management that made those results possible. 3 elements on this chart. First, the exposure line. It starts green on the left at 83.5%. Turns yellow in the middle when we reduce to 54.5%, and ends red on the right at 18.4%. Green means acceleration, yellow means caution, red means braking. You can literally see our risk management shifting gears across the quarter. Then the gold line is AlphaWizzard's performance, and the dashed gray line is the S&P 500. On the left side of the chart, you can see the green exposure line sitting flat at 83.5%. Our overlay was in accelerating mode. Our cross-asset signals showed favorable conditions, healthy credit markets, strong market breadth, positive momentum across sectors. When the data supports it, the system invests with conviction. The gold line shows the result. AlphaWizzard climbed plus 7.5% in January and then plus 13% in February, our strongest month since inception. By early March, we had reached plus 22.2% year to date. The dashed S&P 500 line during this same period barely moved, hovering near zero. That gap is the direct result of our stock selection process, concentrated positions in the highest quality US large caps with confirmed momentum. Now watch what happens in early March. The gold performance line peaks at plus 22.2% and starts to turn downward. The trigger was geopolitical. The US-Iran conflict escalated into direct military confrontation. The Strait of Hormuz, through which roughly 1/5 of global crude oil and natural gas flows, was effectively closed. Oil prices surged over 30%. Energy supply chains were disrupted across Europe and Asia. This was not a normal market pullback. This was a structural shock to the global economy, and it happened fast. Within days, the ripple effects spread from energy markets into broader equities, credit markets, and consumer confidence. Our overlay detected the shift through the data, not through news headlines. Credit spreads started widening, meaning the bond market was pricing in higher corporate risk. Market breadth deteriorated. Fewer and fewer stocks were holding up on any given day. Volatility moved from a low regime to a high regime. These are the kinds of cross-asset signals our system was built to detect. On March 3rd, the system executed its first reduction. Equity exposure dropped from 83.5% to 54.5%. You can see it on the chart. the green line drops to yellow. This was not a panic decision. It was a systematic response to measurable deterioration in market conditions. For 20 days, we held at 54.5%, cautious but still invested. Then conditions deteriorated further. The Federal Reserve held rates unchanged at 3.5 to 3.75%, which was expected. But the real shock was the updated projections. Only one rate cut for the rest of 2026, far fewer than markets had priced in. Fed Chair Powell specifically cited Middle East uncertainty as a key risk to the economic outlook. On top of that, producer prices accelerated at their fastest pace in 7 months, driven directly by the energy shock flowing through the supply chain. Gasoline prices jumped over 40 cents per gallon in a single week. The market was facing a combination of geopolitical risk, inflation pressure, and a hawkish central bank, all at the same time. On March 23rd, our signals triggered the second reduction. Equity exposure was cut from 54.5% to just 18.4%. Look at the chart. The line drops from yellow to red. In total, across Q1, that is a 65 percentage point reduction from acceleration to braking. Now look at where the lines finish at the end of March. The S&P 500, the dashed line, dropped to minus 4.6% for the year. Our gold line pulled back from the plus 22% peak, but settled at plus 15.2%. We gave back some of the gains from January and February, yes, but we preserved the core of what we had built, and we did it by being systematic, not emotional. And look at our current position. We enter Q2 with plus 15.2% year-to-date performance, nearly 20 percentage points ahead of the benchmark. And we are holding 82% cash. If markets continue to fall, we are protected. If conditions stabilize and our signals confirm improvement, we have the dry powder to redeploy. The system will decide based on data, not on feelings about what markets might do. This is not a backtest. This is not hypothetical. This happened in real time, with real capital, including our own. When market conditions deteriorated in March, the system detected the stress through the data and reduced exposure in stages, from 83% to 54% to 18%. We did not avoid the downturn entirely, but by responding systematically as conditions worsened, we preserved the majority of the gains we had built. That is what our risk overlay is designed to do, not to predict the future, but to respond to the present with discipline. Beyond returns, there are a few numbers that tell a deeper story about how this strategy actually works. When markets go up, we go up nearly twice as much. Our upside capture ratio is 185%. Think of it this way, if the S&P 500 gains 10%, our strategy historically captures close to 19%. That is because our stock selection focuses on the highest quality, strongest momentum companies, the ones that lead the market higher. When markets fall, our downside capture is 91%, meaning we actually lose less than the market on average. Now, our portfolio is more concentrated and more volatile than the S&P 500. When we are fully invested in accelerating mode, a market decline could hit us just as hard. But by reducing exposure during the most dangerous periods, like we did in March, going from 83% to 18%, we reduce the impact of those declines on the overall portfolio. That is what brings the downside capture below 100. This is the core of our edge. We capture nearly twice the market's upside because of our concentrated, high-conviction stock selection. And our downside capture is 91%. We lose less than the market on average because our overlay reduces exposure before the worst of the decline. That asymmetry, 185 up, 91 down, is what drives long-term compounding. Let me put a few more numbers around that to show how efficiently this process generates returns. Our Sortino ratio since inception is 2.6. In simple terms, for every unit of downside risk we take, we generate 2.6 units of return. For context, anything above 1.0 is considered strong by institutional standards. Now, our strategy launched in November 2025, so this covers roughly 5 months, a short track record. These numbers will evolve as the strategy matures, but the early data confirms that the process is working as designed. And finally, the number that matters most for capital preservation. Our maximum drawdown has been 8.8%. The S&P 500's was 9.1%. The Nasdaq's was 11.8%. So despite significantly outperforming both benchmarks, our largest peak to trough decline was actually the smallest of the three. That is the risk overlay at work.
Now let me explain why we were able to deliver these results. Our strategy is built on three pillars that work together as a system. Each one played a critical role in Q1. Pillar 1 is our stock universe. Every month, we screen the entire US large cap market using quantitative factors: sector relative strength, financial quality, and confirmed price momentum. Only companies that stand out within their peer group make it through. In Q1, this process led us into a concentrated mix of technology, industrials, and basic materials. Names like Light, Micron, and SanDisk in technology, FedEx and Mastech in industrials, gold miners like IAM Gold in basic materials. These were not random picks. They were the companies showing the strongest combination of quality and momentum at the time of our screening. And the result speaks for itself. In January and February, while the broad market was essentially flat, our selected stocks delivered plus 7.5% and plus 13%. That outperformance came directly from this first pillar, owning the right stocks at the right time. Pillar 2 is our portfolio optimizer. Selecting good stocks is not enough. How you combine them matters just as much. Our optimizer constructs portfolios designed for risk-adjusted returns, with sector limits and correlation monitoring to avoid concentration risk. During Q1, we rebalanced 3 times, in January, February, and March. Each rebalance adjusted the portfolio to reflect the latest data. The February rebalance was particularly significant. It shifted our exposure towards sectors with accelerating momentum, which is exactly what drove the plus 13% return that month. And the March rebalance began rotating into more defensive positioning as the macro environment shifted, adding energy exposure through Valero, for example, which benefited from the oil price surge. This monthly discipline matters. Without it, portfolios drift. Winners become oversized. Losers linger. Our process forces a systematic reset every month. No attachment to positions, no emotional holding, just data. And pillar 3, the risk overlay. Lucas just walked you through this in detail. This is the pillar that determines how much capital we deploy. 20 plus cross-asset signals, monitored daily, automatically adjusting our equity exposure. It is the reason we went from 83% to 18% in March. It is the reason our drawdown was smaller than the benchmark despite our higher returns. These 3 pillars do not work in isolation. They work as a system. Pillar 1 selects the best stocks. Pillar 2 combines them optimally. Pillar 3 decides how much capital to put behind them. When all 3 align, the results compound. When conditions deteriorate, the system protects. That integration is what makes AlphaWizzard different from a simple stock picking strategy.
As we enter Q2, our overlay remains firmly in braking mode at just 18% equity exposure. Our signals continue to show elevated stress across multiple dimensions. Geopolitical uncertainty is unresolved, energy markets remain disrupted, and the Federal Reserve has made clear that rate cuts are not coming soon. The system is positioned defensively, protecting the strong gains we built in January and February. To put that in perspective, we are sitting on plunged 15.2% year-to-date performance while holding 82% cash. That is an unusual position to be in, significant gains already locked in, with the majority of our capital on the sidelines waiting for the next opportunity. We do not predict markets. We do not have a crystal ball. What we have is a systematic process that reads the data every single day and responds accordingly. If the geopolitical situation stabilizes, if credit conditions normalize, if market breadth improves, our system will detect that and begin increasing exposure. We do not need to guess when. The data will tell us. And if conditions deteriorate further, we are already positioned for that. At 18% equity, a significant market decline would have minimal impact on our portfolio. That is the power of being systematic. You do not have to be right about what happens next. You just need a process that responds appropriately to whatever does happen. Q1 was a quarter that tested exactly what our strategy is built for: strong performance when conditions are favorable and disciplined risk reduction when they are not. We delivered nearly 20 percentage points of outperformance versus the S&P 500 with a smaller maximum drawdown. That is not a promise for the future, but it is evidence that a systematic, data-driven approach can navigate real-world challenges. That discipline, knowing when to accelerate and when to brake, is what has defined AlphaWizzard since inception. And it is what will continue to guide us through whatever Q2 brings. If you want to follow our journey, you can find us under the handle AlphaWizzard on both eToro and Twitter. Visit our website at veloriscapital.com. In our cockpit section, we publish weekly performance reviews, detailed market analysis, and educational insights about how our strategy works. There is a lot of content there that goes deeper into what we covered today. And if you want everything delivered directly to your inbox, sign up for the Pit Lane Briefing, our weekly newsletter with all the relevant data and market insights in one place. Q2 will bring new challenges and new opportunities for the markets, and we are genuinely curious to see how it unfolds. Our system will be ready to respond to whatever comes next. We look forward to presenting those results to you. Thank you very much for watching, and we will see you next quarter.